2024, Bitcoin officially entered Wall Street with the launch of the spot ETFs.
Big news, SEC officially approved 11 applications for Bitcoin ETFs.
It's official. ProShares will be the first out with a Bitcoin futures ETF. It will begin trading Tuesday.
Welcome back to Fast Money. Some big buzz on Bitcoin today after Grayscale announced plans to convert its popular Bitcoin Trust into an ETF. Grayscale's Bitcoin Investment Trust has more than $30 billion in assets under management.
But while many people view this as a massive victory for Bitcoin, what if instead it was actually the first step towards its downfall? You see, Bitcoin was never supposed to fit neatly into the old financial system. It was created to challenge it, a decentralized peer-to-peer alternative to banks, brokers, and middlemen who control traditional finance. Now, for the first time, Bitcoin is being packaged, polished, and sold through the very institutions it was meant to disrupt. In light of this, the question we have to ask here is simple, but massive. Are the Bitcoin ETFs a leap towards global adoption, or are they a trap that strips Bitcoin of its core values? Because what's happening right now is bigger than a price rally or a few headlines about mainstream acceptance. This is a fundamental test of Bitcoin's identity, which is why it's important to ask ourselves, are we indeed witnessing Bitcoin's greatest triumph, or instead the start of its slow capture by the system it was supposed to replace? Whatever the answer is today, we're going to attempt to get to the bottom of it by diving deep into how we got here, why the Bitcoin ETFs matter, and what it could mean for the future of crypto as a whole. But first, let's rewind to where it all started. The 2023 ETF filing frenzy that set this entire chain of events into motion. The Bitcoin ETF craze all started in mid to late 2023 when financial giants like BlackRock, Fidelity, and ARK Invest submitted filings for the first US spot Bitcoin ETFs. Now, just a few years earlier, this would have been a pipe dream, but suddenly the biggest names of Wall Street were lining up to offer exposure to Bitcoin. In light of this, the crypto community lit up. Media outlets flooded headlines with ETF speculation. Twitter and YouTube were full of influencers pushing ETF hopium, and for many, this felt like the moment crypto has been waiting for. If institutions were finally entering the space, that meant Bitcoin was about to go mainstream, and prices reacted fast. Bitcoin began climbing, driven by the glowing relief that approval was inevitable. The idea that institutional adoption would unlock trillions in sideline capital became the dominant narrative. But beneath the excitement, something subtle was shifting. Bitcoin, once as a grassroots asset built outside of the system, was being rebranded as a financial product. What initially began as a tool for self-sovereignty was now being welcomed by banks, brokers, and asset managers, the very players it was designed to replace. As time went on, it became more apparent that the doors to Wall Street were opening, which seemed great for crypto at first. The only problem was that the Bitcoin walking through them might not be the same one that came out. Imagine waking up and your entire crypto portfolio is gone. Not because the markets crashed, but because someone stole it. The worst part, it was 100% preventable. In a space built on decentralization and self-custody, the way you store your crypto is just as important as what you invest in. So why are over 97% of people still leaving their assets exposed? There are many factors to consider, but there are three main ways people store their crypto: exchange wallets, software wallets, and cold storage wallets like today's video sponsor, Trezor Save 5. Exchange wallets offer convenience, giving you the ability to trade in and out of different cryptos seamlessly, but are usually in a centralized system. If the exchange gets hacked, shut down, or freezes withdrawals, you could lose access to your funds instantly. Software wallets give you more control because you hold the private keys, but since they're connected to the internet, they're still vulnerable to phishing attacks, malware, and accidental clicks. Lastly, we have cold storage like the Trezor Safe 5, which keeps your crypto offline, far away from hackers. It uses advanced EAL6+ secure element protection and supports thousands of cryptocurrencies. And with the integration of Trezor Suite on both desktop and mobile, managing your portfolio is simple and secure. If you're serious about protecting your assets, cold storage is the best move you can take. Exchange wallets are risky, software wallets are vulnerable, but Trezor Safe 5 gives you maximum security and full control. Get yours today and use the promo code DataDash for 10% off. Secure your future, store it cold. In January 2024, it finally happened. After years of delays, rejections, and speculation, the SEC approved the first wave of US spot Bitcoin ETFs. The response was immediate. Bitcoin surged past $45,000 almost overnight. Headlines called it a turning point. Institutional and retail money flooded in, and for the first time ever, people could get exposure to Bitcoin through retirement accounts, brokerage apps, and 401k plans, all without touching a crypto wallet. For many, this was the dream: legitimacy, access, adoption. Bitcoin was now playing in the big leagues alongside gold and blue chip stocks. Financial advisors were recommending it. Morning shows were talking about it. The phrase Bitcoin ETF was suddenly part of mainstream vocabulary. But beneath the surface, not everyone was celebrating. Because while the price was pumping, so were the questions. Is this really the kind of adoption we wanted? Were we watching Bitcoin break into mainstream, or watching it be absorbed by the very system it was meant to disrupt? You see, ultimately, many skeptics felt that this wasn't just about access, it was about control, about who really owns Bitcoin now and who gets left behind as a result. But before we decide whether this is true progress or a dangerous compromise, we need to look at both sides of the argument, the case for Bitcoin ETFs and the case against them. Now, to many investors, the arrival of Bitcoin ETFs was not a threat to the original vision of crypto, but rather a validation of it. But to understand what I mean by this, we have to first explore 4 key reasons why many people believe these ETFs are a good thing for BTC. First is the conception of legitimization. You see, for years, Bitcoin was dismissed as speculative, volatile, and unregulated, but the approval of spot ETFs by the SEC marked a shift. Bitcoin was no longer just a fringe asset for internet libertarians and tech-savvy risk takers. It was now being recognized by the same institutions that once called it a scam, and the message was clear: Bitcoin had earned its place at the table. Next, there is the concept of access. For starters, not everyone is comfortable setting up a wallet, managing private keys, or transferring crypto between platforms, let alone just trying to figure all that out. Bitcoin ETFs offer a simple way for every investor to get exposure through platforms they already use, whether it's a 401k, IRA, or brokerage account. ETFs make it easy to allocate a portion of traditional portfolios to Bitcoin without technical learning curves. This kind of accessibility is key to mass adoption. The easier it is for people to invest, the more likely Bitcoin is to grow beyond niche communities and into a global recognized asset class. To put it simply, broader participation means more capital, more attention, and ultimately more resilience. By lowering the barriers to entry, ETFs have the potential to accelerate Bitcoin's integration into the financial mainstream. Then comes the concept of liquidity and demand. When large amounts of capital flow into ETFs, it increases overall demand for the underlying asset. That means more volume, tighter spreads, and stronger market efficiency. And in theory, this makes the Bitcoin market more stable and harder to manipulate, helping it mature as an asset class as well. And finally, there is the push towards mainstream adoption. With firms like BlackRock, Fidelity, and Franklin Templeton managing Bitcoin ETFs, Bitcoin is now being talked about in the same breath as gold and equities. News anchors, financial advisors, and institutional investors are treating it less like a gamble and more like a legitimate store of value. To supporters, all of this is exactly what success looks like. Bitcoin is no longer outside of the system, but instead is being woven into it. However, although the road to mainstream success may be paved with good intentions, some argue that it could also lead Bitcoin straight into the hands of the very system it was built to resist. Because while the Bitcoin ETFs have opened new doors, it has also raised serious concerns about what could be lost in the process. For many, the Bitcoin community ETFs are not a sign of progress. They are a warning. You see, the first issue here is in regards to ownership. The phrase "not your keys, not your crypto" has been a guiding principle in the crypto world for over a decade. It means that if you do not control your private keys, you do not control your Bitcoin. Since most ETF investors never touch a wallet, never hold keys, and never directly interact with the network, their coins are held by large custodians like Coinbase Custody, often in massive institutional wallets. And from a security and sovereignty perspective, that is a major trade-off. Then there is the issue of participation. Holding Bitcoin through an ETF does not mean you are a part of the network or really holding Bitcoin at all. You are not validating transactions, you are not running a node, and you are not learning how the system works. Instead, you are essentially getting a price tracking product with none of the underlying involvement. Seeing as Bitcoin was built to be a peer-to-peer monetary system, this setup means that ETF holders are watching from the sidelines. Beyond this, there is also growing concerns about centralization. As more Bitcoin flows into ETFs, a larger portion of the total supply ends up under the control of a handful of custodians and asset managers. This concentration of power reintroduces the very risks Bitcoin was designed to eliminate. If regulators, institutions, or bad actors compromise one of these custodians, the fallout could impact millions of holders all at once. But perhaps the most controversial theory is that this was the plan all along. Some critics believe financialization is the Trojan horse, Wall Street's way of co-opting Bitcoin without having to defeat it. Turn it into a passive investment, remove its self-sovereignty qualities, and make it look just like everything else in the portfolio. It is the same playbook we saw with gold. After gold ETFs launched, prices rose, but true ownership declined. Gold became easier to buy, but harder to genuinely hold. This being the case, many people are worried that Bitcoin could end up following the same path, which would be extremely detrimental to the ethos of BTC in the first place. There is one thing that is becoming more and more abundantly clear. While some people see the ETF debate as an argument about ideals, the reality is much messier, because the Bitcoin community has never been more divided. Since BTC's inception, the Bitcoin community has always prided itself on resilience, but the arrival of the ETFs exposed a major fault line. On one side of this are the Bitcoin maximalists. To them, ETF adoption is not real Bitcoin adoption, but rather a dilution of the original mission. They argue that Bitcoin was built for self-custody, for individual empowerment, for breaking free from traditional finance. To them, watching Wall Street institutions packing Bitcoin into neat little investment products feels like a betrayal of everything Bitcoin was supposed to stand for. You can see this sentiment all over Twitter, podcasts, and interviews. Voices like Max Kaiser, Jack Mahler, and many others have been vocal, warning that Bitcoin's revolution is being slowly neutered in exchange for short-term price gains. Anyway, on the other side are the market bulls, who see the ETFs as a necessary and inevitable part of Bitcoin's evolution. To them, adoption means survival. The more people who buy Bitcoin's exposure, even through custodians and ETFs, the stronger the network effect becomes. Figures like Michael Saylor have leaned into this idea.
So you're like, well, do you want to live in your own townhouse where you can walk out on the street? Or do you want to live in an apartment 35 floors up where you have to take the elevator? The ETF is the 100-story building where you got to take the elevator. You know, what's the problem? Well, you trust the building. What's the benefit? Oh, it's 10 times cheaper and easier to live there. And maybe you can't afford, to buy the townhouse. Right now, today, I think there's 28 different active ETFs.
Arguing that institutional adoption will drive Bitcoin's price higher and ultimately pull more people into understanding and valuing self-custody over time. You see, for the bulls, the thinking is simple. Let the price pump first, let Bitcoin become embedded in the global financial system, and then over time, educate people about sovereignty, self-custody, and Bitcoin's deeper purpose. Overall, the debate between these two groups groups is a battle between principle and pragmatism, between those who want to protect the purity of Bitcoin's original vision and those who are willing to compromise to achieve mass adoption. Ultimately, at the heart of this divide is a simple but critical question. Will Bitcoin remain a tool for self-sovereignty or become just another passive investment? At the end of the day, there's no denying that Bitcoin ETFs are a major milestone. It signals that Bitcoin has gone global. It has entered portfolios of pension funds, retirement accounts, and legacy institutions, along with governments. What once lived on the fringes of finance now sits in the heart of Wall Street. But milestones are not the same as victories, because with every step towards mainstream adoption, there is a risk that something gets left behind. You see, Bitcoin was never meant to be just another investment product. It was meant to be a tool for individual sovereignty, a way to opt out of a broken system, not feed back into it. So maybe the real question isn't whether ETFs are good or bad for Bitcoin. Maybe the real question is what kind of Bitcoin survives this moment. Will it be the one that remains rooted in decentralization, self-custody, and freedom, or one that is slowly reshaped to fit the mold of the very system it was built to challenge? Overall, this issue has very little to do with price. It's about principle and power. But ultimately, it's about you, because at the end of the day, Bitcoin's future won't be decided by BlackRock, Fidelity, or the SEC. It will be decided by who holds the key. So with that said, I'll leave you guys with two questions to ask yourself. Is ETF adoption the start of Bitcoin's victory, or instead its compromise? And will you own your Bitcoin or let someone else own it for you? Let me know your answer to these questions in the comments below. And if you did enjoy this video, be sure to give it a like and subscribe so you don't miss out on videos like this in the future.